Well, it has been quite a year in the markets and the economy and the worlds. I feel like I have said that in other video introductions, but it really is true. It remains true. And so, what we're here to do today is give a brief but comprehensive market and economic update. And I am pleased to have with me, joining me this morning, our Chief Investment Officer, Andrew Beatty. Andrew, thank you so much for joining me virtually today.
Absolutely, Christina. Happy to be here.
Yes. Andrew is a very important part of the team to Hapanowitz. And Andrew, just tell the audience, where you're based out of, and maybe if you want to give a brief background on yourself first.
Yeah, absolutely. So I'm based out of Charlotte, North Carolina, working with the Hapanowitz team here as the investment officer, work with their investment committee, which I think we'll touch on a little bit later in that approach. But my background is in institutional investment consulting. So I worked with large pension plans, endowments, foundations, et cetera, to help formulate asset allocation plans, investment strategy decisions, et cetera. So that's what we're bringing and we're doing and implementing within the Hapanowitz firm.
Yeah. And your insight has just been a wonderful resource to us as we make decisions on behalf of our clients in their portfolios. And so your insight this morning will no doubt be really welcome to the audience who are either listening or watching on YouTube. So let's dive into it. I have some questions I want to ask you. I've got some notes. So if you guys see me looking down, I'm looking at my questions for Andrew. Let's just start off generally, what's been happening? Give us a summary. We've lived 1,000 lives so far this year. Give us a summary of what's been happening so far in 2025.
Yeah, I think that you hit the nail on the head. I feel like we've been telling people, the month of May felt like it was 3 years long. And we've been saying that pretty much every month so far this year. I think it's undeniable that markets have been incredibly volatile so far this year. We do expect that to continue as we go through the second half of 2025. The bright spot here, and if we want to pull up the market performance slides,
yes,
the bright spot here has been outside of the United States, and international equities, emerging market equities, have advanced significantly so far this year. What we have seen is that investors, as opposed to 2023, 2024, where the US market really led the rest of the world, that performance has broadened out. So we have seen the two proxies that we use here, the MSCI EFI index, which is the International Developed Index, and the MSCI Emerging Markets Index, are both up over 10% so far this year, which you can see, and I've highlighted there the S&P and the MSCI EFI on this slide. That isn't necessarily an anti-US trade, which some people seem to think. It's really more of valuations are very attractive internationally right now. The dollar had been incredibly strong coming into this year. We've seen the dollar weaken a little bit. We've seen valuations and investors find those attractive valuations internationally and have put some assets there. Now, they're not avoiding the US. They're not selling out of the US. We haven't seen that. In fact, in domestic markets so far this year, we have seen the S&P 500, even though it was down almost 9% at one point, after the Trump administration announced a 90-day pause on tariffs in about mid-April, US equity markets have come roaring back. And so now we're seeing the S&P up a little bit over 2% for the year. Now, the one key thing there is the other part of the market that some people tend to ignore, but we definitely don't want to, is fixed income. And bonds this year have played the role exactly what we expect, which is to be the ballast, which is to be the stabilizer in an otherwise volatile economy. Bond markets this year have played that role perfectly. They're up a little bit over 2%, almost 3% in some of the fixed income markets. So maintaining that broad-based exposure has been fantastic for us. And as we look to take advantage of opportunities in both the fixed income and the equity markets.
Yeah, it really has been, despite, the fears or, even anxieties that can come from seeing the news headlines every day, and understandably so from an individual's perspective. From my experience, conducting meetings with my clients, when we get to specifically that investment performance aspect of the conversation, it really has been almost a beautiful dance between stocks and bonds in the portfolio. And especially after, was it 2022 when interest rates, historically rose so quickly and by so much. We don't take for granted that beautiful dance between stocks and bonds in the portfolio. That's exactly what we want to happen. That's at least for the clients who come to us, who like to work with us. That's what they're looking for. So, okay, so you talked about the S&P, and no doubt the S&P is, along with the Dow, the NASDAQ, I mean, they're the benchmarks that people look to, right? Now, that being said, when you open up the hood of the S&P, there is so much that it is, comprised of. So talk to me about that in a little more detail. Has it been a broad-based, positive movement so far year to date, or have there been specific sectors or industries that have done better compared to others?
Yeah, it's a great question. And I think we've seen that over the previous couple of years where we've really had the markets led by a couple of names, commonly called the Mag 7. So it's Google, Amazon, Apple, Meta, Microsoft, NVIDIA, and Tesla really led the markets. But this year, and if we go to the next slide, what we've seen is that dynamic has largely changed. We have seen a more defensive tilt to the performance of the S&P. Now that's changed slightly lately as we've seen a little bit more of a re-risking in terms of the equity markets after the announcement of the 90-day pause. But what we've seen, if you look on this slide, is that the more defensive sectors of the market, so think utilities or industrials, have really taken off this year. And that's where investors are going. Again, they're attractive in this type of volatile period. And so that's where investors have been looking. It's why generally we have seen up to this point, value has outperformed growth, which is a dramatic departure from what we saw in 2023 and 2024. But it's again going back to the way that we've approached investments and why it has worked in our favor is that remaining diversified and having exposure across value, across international, across growth, et cetera, it's provided a pretty good tailwind for us this year. But again, I think we'll get to that diversification a little bit later.
All right, thank you for that. Yeah, what we're chatting about right now, it's not necessarily an exact parallel, but somewhat of a parallel. I remember back in 2020, after COVID had broken out, of course, the markets took a nosedive, right? And then the really quick and powerful recovery in the markets, so many, especially the S&P, so many people were asking us, are the markets out of touch with reality? It was almost worrisome to investors that, the S&P was doing so well. And it's almost, the underlying message is almost the same, or like I said, maybe parallel. Correct me if I'm wrong, but when you actually opened up the hood of the S&P, you saw that the positive performance came from a very select few of companies where it made sense that those companies were doing so well in that environment. And then, other sectors, other areas of the markets and the economy were a little more in tune with how things felt as an individual on a day-to-day basis. So yeah, there's so much nuance to it. And that's, I just think it's a really interesting thing to point out. And no doubt there's going to be situations even in the future where as investors, we're asking ourselves, this seems maybe a little too good to be true, or why is this happening when things on a day-to-day basis maybe feel a little different? So
I think you're
all right.
exactly right. And one thing I would note is that despite what I think some people tend to conflate, the economy and the markets are two different things. So we need to make sure that we are differentiating between potentially what people feel and what people see in the economy and the way that the market's reacting, because they oftentimes work in parallel, but sometimes they divert or diverge.
Yeah.
And I think 2020 was a perfect example of that.
Yeah, absolutely. Absolutely. Okay, so let's move on to another topic. Something we talk about internally as an investment committee, information that you are continuously bringing to us here is, data to help us make decisions, right? And so, what we've discussed is, the terms survey data versus hard data. And right now, those two may be giving off conflicting signals, maybe for lack of a better word, in terms of what could potentially happen in the future in the markets and in the economy. So Andrew, could you first just give us a quick breakdown of survey versus hard data, and then, talk to us about, what you're seeing there?
Yeah, absolutely. And I think this is something that people get confused about all the time. So survey data or soft data is just that. They are surveys. They are going to be taken of market participants or of just individuals, and that's going to gauge current economic sentiment, expectations. So think of things like the University of Michigan Consumer Sentiment Survey. That would be a great example of that. Hard data are the things that measure actual results and activity. So many of these will be published by the US government or other governments. So think of things like the Consumer Price Index that measures inflation, or industrial production that is actually measuring the actual results within the marketplace right now. Hard data is what the Federal Reserve typically looks at when they are making their decisions on interest rates. It's also what we tend to pay attention to as an investment committee. And that's because soft data, survey data, is sometimes less reliable. Now, it may be a leading indicator sometimes, but oftentimes hard data is what we want to really base that decision upon.
All right, thank you for that explanation. And that makes sense. I mean, my interpretation, at least for an aspect of survey data, is it takes into account the emotion behind, the sentiment. And a lot of the time, especially if you have those news channels on, there's going to be a lot of emotions, right? So, okay, so talk to us about what we're seeing from a survey data versus hard data perspective here.
Yeah, sure. And I think we want to kind of weave into, what the Federal Reserve is seeing, because the Federal Reserve interest rate policy is going to drive a lot of investment.
Okay, sure. Yes. Yeah.
So I think it's important to remember what the Fed's role is. And they have what's called a dual mandate. And the dual mandate is price stability or inflation, and then maximum sustainable employment. So they want to keep a robust job market out there. So for inflation, they're looking at a target rate of 2% inflation. Obviously, we're higher than that lately, but we are inching towards that. The problem is, if we look at this chart, is that indicators right now, and again, this is survey data, so we want to take this with a bit of a grain of salt here. Survey data seems to indicate that there is going to likely be an increase in inflation. Again, this is survey data, so let's just remember what we think about those. But if we start to see tariffs applied, if we start to see, based on some geopolitical events, oil prices rise, that could lead to inflation. And typically, when the Fed sees inflation, their decision is to raise rates. To your point, that's what we saw in 2022. Inflation was going up. The Fed responded by raising rates, and that is what weighed on the markets. Right now, and if we go to the next slide, what we're also seeing, however, is a bit of a softness in the job market starting to creep in. So this is a chart that's showing the long-term unemployment. So folks that are out there looking for jobs and they've been unemployed for more than 15 weeks, that is starting to tick higher. Typically, when the job market starts to weaken, the Fed will cut rates. So the problem that we have right now is, Christina, I think to your point, we're seeing some conflicting data. We're seeing data that shows inflation may be rising. We're seeing data that shows that the job market may be softening. Those have different policy prescriptions for the Fed. And so right now, the Fed is a little bit hamstrung, or they're being forced to sit on their hands. And I think we go to the next slide. That's what's really important right now for market participants. What this slide shows is what market participants think the end of the year Fed funds target rate will be. Now, I won't say most, but a plurality of market participants think that there's going to be somewhere between a 25 and 50 basis point rate cut before the end of the year. But as you see on this chart, the decisions here and the opinions vary wildly, from no cuts at all by the end of the year to almost 1% cut by the end of the year. Typically, we're going to see market participants, because the Fed is so data driven and so transparent in their decision-making process, we're going to see this really concentrated in one or two of these buckets. But right now, with the uncertainty that we're seeing, market participants just don't know when or how the Fed is going to react.
Thank you for that. And it's tough because a lot of the time as advisors, we don't have the crystal ball, right? So, we're not able to give an exact answer to some questions that people have for us. And the questions are, it's very understandable that they have certain, those specific questions. But what I'd like to do is, and we didn't really discuss going into this, so sorry for putting you on the spot, but can you just remind our viewers and our listeners, why should a typical investor who's retired, living off of their portfolio for income, for example, or even someone who is not yet retired, why do advisors, as advisors, why do we watch interest rates so closely? Why is this such a big discussion internally during our investment committee meetings, for example?
Yeah, it's a great question, and one I'm sure that you all get a lot of times from your clients. But the reality is that if interest rates affect both consumers, it also affects companies out there. And so I'll
Mhm.
start with the consumer side. Obviously, a lot of loan rates, a lot of earnings rates, money market accounts, et cetera, are at least tangentially tied to interest rates. So as they go up and down, that will impact people's ability to afford homes with mortgage rates, or new cars, or even to get money out of their money market accounts. When
Mhm.
rates are
Right.
incredibly low, money market accounts, even or short-term treasuries, are going to not pay a lot of yield. So that's going to impact where you have to go as an investor to pick up additional income. On the business side, when rates are higher and companies have to go to the financial markets to either issue equity or debt to raise money for themselves, when interest rates are high, their cost of capital is increased. So if we think about companies that are potentially, let's think about small cap companies. They have to fund their growth. They typically are not going to have a lot of cash flows or revenues to be able to fund their own growth. They have to go to capital markets to either issue debt or equity to raise money so that they can grow and become no longer a small cap company.
Mhm.
And if that debt is more expensive to issue, then it costs them more money, and then it proceeds to then weigh on their ability to grow. So that's where we see it both from the consumer side and from the company side, that interest rates are incredibly important.
Yeah, absolutely. There's a trickle effect to everything, right? But
Absolutely.
especially when it comes to interest rates. So, all right, was there anything else that you wanted to discuss regarding interest rates, the Fed, anything else before we move on?
I think
We
that's
just,
good for now. Let's
okay.
move on to probably the topic that's on everyone's mind, I think.
Yeah. Yeah, which is what's going on globally. And that's the thing is global conflict is nothing new to us. I think, what is a new element, though, is the fact that the U.S. has become involved in a global conflict. We're filming this on Monday, June 23rd, and I think what it was as of Friday, this past Friday, where the U.S. officially became involved in a global conflict with Iran, of course. So, can you just talk to us about, in the midst of global conflict, first, what is currently happening, but just in general, what should we as investors expect? How should we be reacting to this, responding to this? Just talk to us about that, please.
Yeah, absolutely. And I think to your point, there are a lot of issues right now globally. And I think it's kind of gone a little bit to the back burner now, but we still have the threat of tariffs being applied by the Trump administration on effectively every country in the world.
Mhm.
That is would typically be the lead storyline everywhere. But
Mhm.
right now, it's kind of being pushed to the back burner again by things like the conflict between Russia and Ukraine, or right now, to your point, uh, the impact of the Israel Hamas or Israel Iran conflict that the U.S. just entered with the bombing of Iranian nuclear sites over the weekend. So
Mhm.
there are a lot of issues right now. There's a lot of uncertainty. There's a lot of conflicts as we look across the world. That could lead investors to think, you know what, I'm out. There's too much uncertainty. There's too many conflicts right now. We need to take our ball and go home.
Right.
But, and Christina, if you'll go to the next slide,
Mhm.
the news flow has been enormous. But one thing we always want to keep in mind is there are multiple factors that go into market performance. And I know that the font size is incredibly small here, but I'll kind of describe what we're looking at here. This is a slide, unfortunately, we have to continuously update because there are more and more global conflicts. But we looked back at the S&P going back to the bombing of Pearl Harbor and the market returns in the 3, 6, and 12 months following global conflicts. And it ranges from the bombing of Pearl Harbor to attacks on Saudi Aramco facilities, etc. What we have seen is that markets are incredibly resilient. The U.S. market in particular is incredibly resilient. So the S&P in that 3, 6, and 12-month period following these global geopolitical conflicts or issues, we've seen them be up a little over 2%, almost 6%, and almost 8% respectively over the trailing or the following 3, 6, and 12-month periods. That doesn't mean that there will always be an advancing market, but what it does mean is that we need to look at this not in the context of just bombs are falling, bullets are flying, tariffs are being implemented. This should be an absolute fear for everyone, so we need to get out. In fact, what it probably does is creates volatility, and that eventually probably creates some opportunities for us.
Mm-hmm. It's so true. A phrase that Bob uses a lot that just hits home for us here is volatility is your friend if you use it to your advantage. And so it's as much of a mindset approach as it is, a mathematical approach to navigating, this type of conflict. And I think this slide is so telling, especially those averages, because to your point, no, not every conflict is going to result in a resilient market over that 3, 6, and 12-month period. But the overwhelming trend tells you that if you try to, guess, which time around it will or will not result in a resilient market, I mean, you could be setting yourself up for a loss. I know we're going to talk about market timing just a little bit, and maybe that's a segue into it. I'm not sure, but again, I mean, this is why a lot of people work with an advisor, is because they have that sounding board to make sound decisions rather than knee-jerk reactions to, again, what we see in the headlines. So yeah, thanks for this slide. I think it puts it all into perspective. Our version of this slide, all of the advisors in our office, we have an S&P chart that goes all the way back to the Pearl Harbor attack, maybe even a little further back. And to your point, the dips we're seeing now, when you just look at it on a graph, they don't look any different actually than the dips that we saw in years past. What's different is just what is behind it to cause that volatility. So it's helpful to look at this to keep that long-term perspective and put everything into perspective. So all right, so let's talk about we discussed a lot of great background information, just a lot of what's going on. Can you tell our audience, our viewers, and our listeners, what are we doing here at Apanowitz to actually put this information into action on behalf of our clients so that we can use the volatility to their advantage in a responsible way, of course?
Yeah, absolutely. And I think this is really important. And one of the things, again, I know there may be a lot of fear out there. There's a lot of uncertainty. But one of the things that we do not try to do is time the market. And the reason that we don't try to time the market is on this slide right here. Most people aren't very good at timing the markets. Professional investors aren't very good oftentimes at timing the market. And what we'll see is that if we look back here, and this is going back to 1990, if in a given year you missed the one best day of the year, you're going to drop your annualized performance by more than 3%. If you miss the 3 best days, so let's assume that you take your cash out of the market because you're afraid, typically we're going to see some of the best days in the market around some of the worst days. If you miss those best days, if you miss 3 of the best days of the year annually, going back to 1990, again, this is not a very short time frame here. We're going to go from almost a 10% annualized return to effectively a 0% annualized return. So timing the market doesn't work. That's not what we're looking to do. We're remaining invested. And the reason is, we go to the next slide, is that volatility, and Christina, you just pointed this out, over the longer term period, the S&P 500, if we use that as a proxy for the US domestic equity market, has risen. It has been consistently rising, doesn't mean all the time, but over time it does. Now, that doesn't mean there aren't drawdowns, they're not pullbacks. As this slide shows, what we tend to see over the period of time, and this goes back to 1980, is that the average intra-year, so not over multiple years, but within 1 year, the average drawdown is almost 14%. But over that same period of time, only 10 years have finished with the S&P in negative territory. So volatility should be expected. Market timing is not something that we are going to hang our hats on because it's really, really difficult to do. So what we're going to do, and the way that we approach markets, is that we have, and Christina, you mentioned this earlier, is an investment committee approach. And that's incredibly important because one of the things that we want to stress here is that committee approach provides a rational and a repeatable process to how we manage portfolios. And that is incredibly important because obviously, if you have one decision maker who's making all of the decisions, they can be persuaded, I think to your point, depending on which news source they're citing, depending on what they're reading, they can get very, very scared. They can be very, very aggressive. And that's sometimes it's going to be great. Sometimes it's not going to work out. What we do here at Hoppanowitz is we convene all of the senior members of the team frequently to meet to discuss geopolitics, economics, market returns, market projections, etc., so that we can understand, first of all, the risks that we're taking. And that's really important for our clients. We want to make sure that we're taking risks where appropriate. The second thing is, if we have an idea, and ideas can come from anywhere within our group, they are tested by the committee. Investment theses, investment ideas are tested so that we are all sure that if an idea gets through the IC, that it is in the best interest of our firm and of our clients. And that's incredibly important. That's most important when markets are incredibly volatile, like they are now. Look, everyone thought they were a genius in 2023 because the market was going up. All you had to do was buy in and things went north. That's not the case now. We see drawdowns, we see volatility. So what we want to make sure is that ideas are being tested, that investment theses are being questioned, and that we're coming as a group to a consensus so that we're making the best ideas or best investments for our clients. I think one of the things that we'll touch on here, though, is that what we're doing is not differentiated from what we have always done. And that is, the first one is diversification. We are going to remain diversified. We're going to remain invested. And the reason we do that is so what we call the participate and protect. When markets are up, we want to participate in that up market. And when markets are down, we want to be positioned so that we're not hopefully taking all of that downside risk. Participate and protect is something we talk about all the time, and we want to remain with that as a focus, specifically during periods of volatility. The other thing that we're always going to focus on are fees. Investment strategies all have accompanying fees to them. We're going to look at fees and risk as a budgetary item. So if we're going to be allocating our fees appropriately, if we're going to be allocating our risk appropriately, where are we going to generate alpha? Where are we going to generate additional returns based on where we allocate those assets? So what we have done is look in large cap space and domestic equities, that's typically not a place where active management is going to succeed. So we're not going to pay a lot of fees to access that part of the market. In small caps, in international markets, in some fixed income markets, historically, active management has worked there. So we're going to barbell our approach with some passive approach in the more efficient markets, and then an active approach in less efficient markets where active management has worked over longer periods of time. The other thing that we always want to do is remain tax efficient. Now, not every account is taxable, but for clients that are concerned about taxes, we want to make sure that we are being tax efficient in the way that we are allocating assets. And lastly, I think, and this goes really to the heart of the Hoppanowitz approach, is customization. You can go to any firm out there and they will put you into a portfolio that's going to mirror everyone up and down your block. That's not the way that we approach investments. We want to make sure that we are customized based on our clients' investment time horizon, risk tolerances, income needs, etc. So we are The moral of the story here is that we are remaining invested, we're remaining diversified, and we're keeping a little bit of dry powder there just in case we see opportunities in the marketplace, given this volatility to, as Bob puts it, take advantage of that volatility as an opportunistic investment time.
Yeah. Thank you for that explanation. A lot of our clients, at least, they might not know what goes into our processes, right? And so you explained it in a way that's really approachable and makes it concrete. So thank you for that. And wow, these last two slides are so powerful. I mean, this one right here is just, it's such a powerful message. I know when we have talked over the last few minutes about market timing, and these slides specifically address market timing in terms of getting out of the markets, right? Out of fear, out of worries, which all of those emotions are completely understandable. This is another question where I'm going to kind of put you on the spot, Andrew, if that's okay. But one that came to mind is just anecdotally, when I have meetings with clients, something that somewhat frequently happens is individuals asking me about, well, based on what's going on, should we get more aggressive or less aggressive, right? So not necessarily completely getting out of the markets and going to cash, but maybe adjusting from a 60-40 to a 70-30 split, or from a 60-40 to a 50-50. And as advisors, we tend to try to avoid making adjustments like that simply based on what's happening in the current time. Would you be willing to discuss why that might not be in an individual's best interest to, make an adjustment on the fly like that to something, a little more, a little less aggressive just from what's going on currently?
Yeah, absolutely. I think there are kind of different ways that we can approach this. The first is obviously if we're looking at it, you have a 60-40 approach. If you want to go 70-30 to be more aggressive, or if you want to tone it down, maybe go 50-50 if we wanted to be more balanced in our approach. That is one way to go. It's not what we would prefer because, again, typically investors are not good at market timing. So if we're saying, I'm seeing volatility, I want to go less aggressive right now, that's probably not going to be in your best interest on a broad asset class basis. Now, that doesn't mean we can't take some risk off the table, but we'll do it through other means. And a great example of this is as we were coming out of 2022, fixed income markets were absolutely destroyed. They were hurt really badly, as you mentioned earlier, Christina, that the Fed raised rates incredibly fast. That put pressure on fixed income markets. So we wanted to keep fixed income exposure. So what we did is go into what's called a treasury bond ladder. So we started bolting on individual treasury bonds to pick up an incredible yield, typically over 4% yield annualized on those treasury bonds. But they're backed by the US government. There's very little risk involved there. So we took the opportunity to add in very high quality issues into our portfolios with very attractive yields. That takes our risk down, but it also gives us that advantage that we can be very, I wouldn't say aggressive, but we can be very nimble in terms of what we do. Those are incredibly liquid securities. We can get into and out of them when we need to do so. And that presents another opportunity for us. So as we came into 2023 and into 2024, we saw an opportunity in what are called preferred securities, which are kind of a hybrid between equities and fixed income. So we started to diversify, take that volatility and look at opportunities in the fixed income market and see that preferreds were incredibly attractively valued. They were incredibly attractive on a momentum basis. And so we applied some of that dry powder that we had into an opportunity in preferreds that was incredibly well timed. And I use that term very loosely because it wasn't like we made that decision in an afternoon. We talked about preferreds for quite some time, decided that it was the right place to be, that it was an opportunistic trade to make. We made that trade. So if you're looking at this from a broad asset class perspective, that technically increased risk. But because we had done the due diligence, because we had evaluated the market and we saw that opportunity, that was a risk that we thought was something that we were willing to take. So I think what investors should remember is that as your advisors are looking at risk within your portfolio, within your 60/40, within your
Right.
80/20, and they can toggle up and down the risk based on the market opportunities rather than you saying, I read an article here, I think we need to de-risk. We're paying attention to the markets constantly. We're looking at the hard and soft data. We're making decisions on a rational and repeatable basis. So hopefully you will understand that Hipanowitz has risk in mind when we're allocating your portfolios.
So well put. And thank you for those specific examples. What I tell my clients if they ask me, that kind of question is just because we might not be recommending a change, an overhaul to the investment objectives, right? From 60/40 to 70/30, for example, it doesn't mean we're not doing anything. It's just that the adjustments we're making are to carry out that high level investment objective. And so the examples that you just mentioned are, just again, perfect examples to explain exactly what I mean by that when I talk with my clients. So yeah, thank you for that. I know we didn't necessarily plan on discussing that, but it's something that I think it's a thought that anyone has come across, as they look at, their accounts or see what's going on is, oh, should I be, so heavily invested in stocks? And, for those listening that are clients of Hipanowitz currently, that's why if you recall in your initial conversations or meetings with your advisor, when first establishing the relationship, your advisor, we tend to get pretty detailed in this aspect of the conversation because we want ideally that investment objective to be timeless for that phase of life that you're in, right? And so talking about your comfort level with risk versus return, not just in good times, but in not so good times or volatile times as well. We like to put in that work up front so that we can try to avoid the shifting, the knee-jerk reactions as much as possible. So, all right, was there anything else? I think that's everything that we said we'd cover today. Thank you so much, Andrew, for spending time with me this morning and just sharing your wisdom and your insights. And for anybody watching or listening, if any of this piqued your interest, if you have any follow-up questions, please reach out to your advisor here at Hipanowitz. If you're not a client of Hipanowitz, but you have some questions, reach out to us. We're here for you. Make sure to hit subscribe on our YouTube channel to stay up to date with future videos being uploaded. And we will see you guys in the next video. Thank you, everybody. Thanks, Andrew.
Thanks, Christina.